China just made a $200 billion move. Off the books. While Washington blasts Beijing for currency manipulation, China's quietly unloading US dollars and hoarding gold at a pace not seen since World War II. But here's the twist. Analysts say they may be hiding 10 times more than they report. And as Besant demands China follow currency rules America rewrites every quarter, the US is slashing rates, printing money, and watching its own export stall while 688,000 jobs vanish in just 5 months. So here's the real question. What if China's already moved on and no one followed? Because this isn't a trade dispute anymore. It's the start of a global financial reset, and the countdown has already begun. In May 2025, the US Treasury declined to label China a currency manipulator, yet simultaneously accused Beijing of lacking transparency in its exchange rate policies. That's while Washington added over $1.6 trillion to the debt this year alone. And the Federal Reserve prepares to cut interest rates by 100 basis points starting September, according to UBS. This combination, rate cuts, monetary expansion, and deficit-fueled stimulus, undermines the very credibility Besant seeks to defend. The dollar has already weakened 8.7% since December, according to Bloomberg FX Index, which theoretically boosts U.S. exports. Yet manufacturing job losses surged by 47% year-on-year in May, as reported by Challenger, Gray & Christmas. So the question is no longer whether China is tilting the board, but whether Washington is demanding fair play while stacking the deck. And yet, the most destabilizing move? It didn't come from Beijing. It came from a vault buried under Maryland. According to the Treasury's own policy framework under the Trade Enforcement Act of 2015, a country qualifies for enhanced scrutiny if it runs a $15 billion trade surplus with the U.S., has a current account surplus above 3% of GDP, and persistently buys foreign exchange. But Bloomberg Economics notes that 5 of the 9 countries on the current monitoring list, including Germany, Japan, and Switzerland, meet those thresholds not because of foul play, but due to high savings rates, demographic shifts, and structurally export-led economies. Meanwhile, U.S. fiscal policy continues expanding the deficit, which hit $1.97 trillion in the first half of fiscal year 2025, the fastest widening since the 2020 pandemic. The contradiction? America demands currency stability abroad while destabilizing its own markets at home. Even the Wall Street Journal noted in June that the U.S. remains the world's largest manipulator, in effect, not by intent, but by inertia. Yet the Treasury threatens retaliation without ever turning the mirror inward. The U.S. trade deficit narrowed by a record $76.7 billion in April, driven not by booming exports, but by a 16% collapse in imports, particularly in consumer electronics, industrial equipment, and automobiles. According to the Bureau of Economic Analysis, exports rose just 3% to $289.4 billion, buoyed by energy and raw materials, but high input costs and rising wage pressures continue to cripple the industrial base. The ISM Manufacturing Index has remained under 50 for 11 consecutive months, signaling contraction. Even with a weaker dollar, U.S. goods remain among the most expensive globally, with domestic steel priced at $958 per ton versus $600 in China, as tracked by S&P Global. Besant's pressure on foreign governments to strengthen their currencies appears less like economic strategy, and more like a workaround for supply chain failures and reshoring delays. But if the only way to lift U.S. exports is to force others to become less competitive, can that be called a policy, or is it a confession? China's central bank added 60,000 ounces of gold in May alone, marking its 7th straight month of accumulation and pushing its reported reserves to 73.83 million troy ounces, according to the People's Bank of China. But trade records tell another story. The United Kingdom exported over 30 tons of gold to China in March, while Beijing officially declared just 3 tons of purchases. Analysts at Metals Focus estimate that China may be underreporting its holdings by 60 to 70% by funneling purchases through state banks, the PLA, and sovereign wealth vehicles. Gold has risen 27% this year, hitting $3,500 per ounce in April. Yet, the People's Bank keeps buying, ignoring price signals. This isn't about return on investment. It's about escape velocity. Bloomberg's Ziad Daoud wrote, "For Beijing, gold is a firewall against sanctions, against dollar volatility, and against transparency." The more the United States lectures about currency, the more China responds, quietly and in bullion. Global central banks are on pace to purchase 1,000 metric tons of gold in 2025, equaling nearly $100 billion in capital reallocations from dollar assets, according to data from the World Gold Council. The trend, already dominant in 2023 and 2024, has accelerated post-election as Trump's tariff policy rattles global trade confidence. Vietnam, Singapore, Turkey, and even France have increased gold allocations since January, while the ECB warned in its April report that persistent fiscal risk in the United States has compromised dollar reliability. Meanwhile, the International Monetary Fund noted in May that the dollar's share of global reserves slipped to 58.4%, its lowest in 28 years. And it's not just central banks. Bloomberg reports that sovereign wealth funds in Norway and Saudi Arabia have trimmed treasury holdings in favor of gold ETFs and physical bullion. What's spooking them isn't ideology, it's arithmetic. And the deeper you look into their balance sheets, the louder the message becomes. Trust is leaving the dollar, gram by gram. Labeling China's currency strategy as manipulation ignores a structural reality. Export-led economies respond to tariffs with currency moves because they have no fiscal alternatives. According to Bloomberg Economics, countries like China and Vietnam absorb shock by controlling volatility, not gaming the system. The PBOC has kept the RMB within a tight 2% trading band, even as global pressures mount, and hasn't intervened in open markets since the first quarter, per Reuters. Meanwhile, the United States Treasury's monitoring list has ballooned to include Ireland, Switzerland, and Singapore, hardly the usual suspects, despite all operating under IMF-defined market-based regimes. In May, the IMF reiterated that exchange rate flexibility is necessary under open capital markets, indirectly undercutting Besant's hardline stance. The deeper issue may not be China's defiance, but Washington's assumption that its rules should apply even when the terrain has changed. In May alone, United States employers slashed 93,000 jobs, led by tech, retail, and logistics, pushing year-to-date layoffs to 688,000, the highest since the 2009 recession, according to Challenger, Gray & Christmas. That spike coincides with a 16% drop in imported industrial inputs, which the Wall Street Journal links to tariff front-loading and collapsing demand. While Besant pushes currency diplomacy abroad, the domestic industrial engine is sputtering. The Atlanta Fed's GDP Now model downgraded United States second quarter growth to 1.3%, less than half the 2.8% posted in late 2024. Axios reported that reshoring initiatives have stalled due to cost overruns and equipment delays tied to weakened global supply chains. For a real-world impact, consider auto supplier Marelli, which furloughed 2,000 workers across 3 states last month due to component import disruptions. The irony? While the United States blames currency distortions overseas, its own policy cascade is bleeding jobs on the ground, and not in the places the headlines usually follow. Since Trump's tariff rollback to 30% in April, China has quietly intensified its asset diversification while avoiding open confrontation. People's Bank of China gold reserves rose to $242 billion. But analysts at Standard Chartered estimate an additional $120 billion may be held through provincial banks and non-central channels. The opacity is intentional. Unlike the United States, where treasury bond ownership is public, China has created a multi-layered reserve system that includes the military, state-owned enterprises, and local governments. Reuters reported that China's official foreign exchange reserves dropped by $40 billion in the second quarter. But gold holdings surged by over 20% in that same window. Beijing's calculus shield itself from United States asset exposure, not via escalation, but subtraction. While Trump emphasizes bilateral respect, post-call with Xi, Beijing is restructuring global exposure without issuing a press release. And what Washington hasn't yet grasped is that this isn't a sprint to dominate. It's a race to decouple. Despite the tough rhetoric, the Treasury's June report stopped short of formally designating any country as a manipulator. Because honestly, such a label triggers legal and economic retaliation. According to a former senior official quoted by Bloomberg, naming China would require sanctions or tariff escalation that could collapse the trade talks entirely. Meanwhile, United States allies like Japan and Germany continue running surpluses well above the 3% GDP threshold with no meaningful policy shift. In fact, Germany's current account surplus hit 7.4% in the first quarter of 2025, per Deutsche Bundesbank. The Wall Street Journal reports that Ireland and Switzerland, just added to the monitoring list, have already filed diplomatic protests, calling the designations misaligned with their open market principles. The deeper issue is credibility. Washington is demanding compliance without consequences and leveraging rules that the IMF itself hasn't enforced in a decade. So, the more Besant threatens enforcement, the more global markets treat it as posturing. And the more likely it is that exporters will continue managing their currencies on their own terms. So what happens next? China isn't just refusing to play by Washington's currency rules. It's building a new financial map, 1 gram of gold at a time. And while Besant warns of manipulation, global central banks are sending a clearer message. The dollar may still be dominant, but it's no longer untouchable. The reserve shift isn't theoretical. It's liquid, moving, reallocating capital away from treasuries and toward anything the United States can't freeze. But if China is already hiding billions in off-ledger gold, and United States allies are resisting treasury directives, what happens when the next trade shock hits? Drop your thoughts in the comments. Who's really driving this financial reset? And if gold is Beijing's firewall, what happens when Washington lights the next match? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.